Good afternoon to everyone who is present for this session. So today I'm going to take a webinar for 1 hour on the basics of business finance. So anybody has any question in between can unmute themselves and they can ask the question. So just let me know as and when you have any query, you can just let me know accordingly, okay? As and when we progress the session. So basically, when we are talking about business finance, it is nothing but managing the resources for any enterprise. So when we talk about an enterprise can be a commercial enterprise or it could be a not-for-profit kind of an enterprise. So basically what we're going to discuss over here today is the financial perspective from the commercial enterprise point of view. So the discussion will be limited only to corporate enterprises basically. So whenever we talk about business finance, it is more said about that. It is all about bringing in money for starting the business. You need funds to manage your business and you need funds for growing your business. So basically how this management takes place, how you source in the finance and for what purposes you're going to use this. That is what I'm going to touch upon in today's session for 1 hour. So to begin with, I'll just share a PPT. It's only around about 4 to 5 slides, and in between, I'm going to use a whiteboard wherein I'm going to write certain things, okay, to explain the PowerPoint presentation. So in between, you have any query, you can just ask. So just let me know if the screen is visible to you. I'm going to share this PowerPoint presentation. Is it visible to you all? Jyoti ma'am, can you see this PPT?
Yes, ma'am. It is visible.
So basically, to begin with the concept of business finance, it is basically financing a business for a commercial purpose. Now, when we talk about a commercial purpose, here the major objective of the enterprise is to earn profit. So, as I said, this entire 1 hour, we are going to talk about all those enterprises which are more driven towards profit rather than service kind of an organization, which is for some charitable or for not-for-profit kind of an enterprise. So any enterprise which has a profit objective needs money for various purposes. Now, the fund requirement would be for starting a new enterprise, or it could be to manage the enterprise. So once you've started the business, you need money to manage it. So you need, there are a number of expenses that needs to be met on a day-to-day basis. So for that, you need funds. And once you settle down, your business starts where the performance goes good, then you need to expand the business, for which you need the resources. So basically, when we talk about business finance, it's just pulling in the resources from one end and making use of those resources to achieve the commercial objective, which is nothing but the profit. So normally, from where does the money come in? So there are two sources. It could be the capital and it could be the credit which the enterprise is going to avail. So what I'm going to talk about is for next few minutes is what are the different sources from where the funds are made available to the business enterprise. So now let us just go through the next slide. So the major source of funds which comes into a business is from the ordinary shares, which is also known as the equity capital of the company, or it is also known as the owner's stake. The second source of funds that we want to discuss today is the retained earnings or the reserves. And then the firm has surplus and of course the credit part, that is the borrowings, or we call it as a debt. So these are the 4 points that I'm going to discuss under the sources of funds. Now when we go to the sources of funds, so is the screen visible to you all?
Yes, whiteboard.
Whiteboard is there, no?
Yes.
Just a second. Just give me a second. So the whiteboard is visible, no?
Yes, ma'am.
So now let us discuss about from where a business will get the funds. So there are two things in business finance. One is bringing in the money, and the second part is how you're going to use that funds. Okay. So now let us look at from where the money is going to come in. Now, as I said, normally the money comes from various sources. As we've seen in the present PPT that there are different sources. The first source, normally what we talk about is you call it as the equity share capital. This is the first source of funds that come majorly a company would. So anybody who knows about equity share, anybody? Students, you all can unmute yourself. You can answer. Huh? So anybody who can just let me know what is an equity share capital about?
Rishikesh, they have the rights to unmute themselves, right?
Yes, they have.
Okay.
Anybody?
Alternately, you can also type it in the chat box.
Anyone? What's an equity share capital?
Okay, ma'am, maybe you can proceed.
I think I'll only proceed. Now,
Yes.
Let's start with what is the meaning of a share. Share is nothing but it is known as a part of capital. So every company needs money. The basic initial investment, you call it as a capital of a company. So when you say a share, that means a stake or it is a part of capital. Now let us say, now a share is nothing but a part of capital. Now when you say equity share, what is an equity? Equity is nothing but there are certain characteristics what a share has. Now equity share comprises of, the first aspect is it is lifelong investment that an investor will do. So it's a lifetime investment in the firm. So there are no fixed returns and the repayment happens only in the end. So repayment is normally at the time of liquidation of business, normally. So now here, what you can see is when you talk about equity share, why do we call them as the owners of the company? The reason being, whenever a company needs money, it will issue the shares in the market, normally known as an equity share. They'll issue the share in the market. Now, people like you and me, we can buy those shares. So once you purchase those shares, you become a shareholder of that company. Now, what are the characteristics if you buy an equity stock? Whatever money you have invested, that will remain in the firm or with the enterprise throughout the lifetime of that enterprise. So till the company goes into liquidation means closure of business or winding up of business, the investment will vest with the company. It will be there with the firm. Second is now your investment, you're making it for the lifetime. Second part to it, there are no guaranteed or there are no assured returns to it. So against, when we say share, what is a return that when you make an investment, you expect a return? So a return on every share is known as a dividend. Okay, so there are no fixed returns that are associated with equity investment. So what is happening? You are investing for a long tenure, but there are no assured returns that are there. So ultimately you are taking a risk. Third part is whenever you want your money back, that you will get it only when the company goes into liquidation or when the firm is going to close the business. Now, because of these three characteristics, there is high amount of risk. So the risk component in this kind of investment is very, very high because the tenure of investment is more and there are no returns, no guaranteed returns that are assured during that time period. Now, when we say return on every share, now the share will give you some returns. The returns on share is known as, you call it as a dividend. So when I say there are no assured returns, that means the dividend is not, you cannot predict whether you will get the dividend or not. So there is no guarantee. The company may make a profit, the company may not make a profit. So dividend is not guaranteed to the shareholders. So because of these three characteristics, There is high amount of risk involved in this kind of an investment, and because of which they become a part of the owner's stake. And therefore, equity share capital is also known as the owner's capital. Any question till here? Participants, any question? Okay. So when there are no questions, I'll move ahead. I'll assume that everybody knows everything and I'm going to move ahead. So whenever we talk of returns, one is the dividend, that is on every share, the company is going to pay a dividend. Now, why would anybody like to invest over here? Okay, somebody has raised the hand. Rishikesh sir, can they unmute and answer?
They can unmute themselves.
Good evening, ma'am.
Please unmute yourself, because the reason is when I'm using a whiteboard, I cannot see the chat window. It's not visible to me. Okay, so you can
Okay,
just
ma'am.
unmute and yes.
Ma'am, I have a doubt. If we want to sell our equity share, then you said earlier that anybody want to cash or anybody want to transfer their shares only when the company's liquidity.
I didn't say transfer. You will get back your money. Now see what happens when the firm is issuing the share for the first time. Now suppose, let me take an example. There's a firm like AB Limited. Now this company needs 50 lakh rupees, for example. I'm just quoting this. Now this is the total capital which this company wants. Now they are planning to raise this money through equity capital. So what they will do initially, they'll fix up a initial price of that share. So that initial price, you call it as a face value. So the face value, let us assume the face value is kept as ₹10 for each share. So how many number of shares would be issued by the company in order to raise 50 lakh of capital? Every share is of ₹10 and the firm needs 50 lakh rupees. That means the company has to issue 5 lakh shares to raise a capital of 50 lakhs, correct? Now, suppose this 5 lakh shares are issued in the market. Now you buy, now out of these 5 lakh shares, let us assume you are going to buy 10,000 shares. Okay? So you bought 10,000 shares at the rate of, say, now I'm not getting into the details of the issue price. So let us say you purchased it at a face value. So your total investment in that company becomes 1 lakh. So out of this 5 lakh or 50 lakh, you become a stakeholder, or your right will be limited to 1 lakh. Okay, now you purchase the share. Now whatever money you have invested, this 1 lakh, this will remain with the company throughout the lifetime of that firm. Okay, now this is, you bought the shares. Now what will happen once the shares are listed, once the company issues the shares go on the stock exchange. So you all know Bombay Stock Exchange, National Stock Exchanges are there. So when these shares are listed on the stock exchange, then further buying and selling takes place. Okay. Now this is first time when you purchase the share from the company. So your investment is 1 lakh. Now let us say this 10 rupees share, once it is listed on the stock exchange, the trading starts. Now what is the meaning of trading? There is a buy and sell that is taking place. Now this 10 rupees share, let us say, has the value, the market value now, because it is being traded in the market. Now the market value of the share has, say, gone up to 20 rupees. Okay. Now you want to make a profit now because you purchased it for 10. Now it's trading at 20. So if I sell the stock for 20, I will get 2 lakh rupees today. Correct? Now see, who is getting the money? Here you are getting the money. So instead of you becoming a shareholder, the other person will now become the shareholder. But that initial investment, what was there of 1 lakh, that is with the firm. So what I meant about lifelong investment is of this amount, initial amount which you have paid to the company. So that will remain with the firm throughout the lifetime. Is that clear now? I hope I've answered your question.
Yes, ma'am.
Is that clear? Yes, somebody had asked a question, no? So I think I've answered that. So once this investment of 1 lakh will be there with the company, now whatever trading will take place, it will be between you and some other buyer. Okay, you are going to sell the stock or you're going to buy the stock. So it's not between the company and you. It is going to be between two investors. Okay. So the benefit ultimately goes to the investor and not to the firm. Okay. So normally what happens whenever in an equity share, now since this dividend, when we said the returns are nothing but the dividend that a company is going to pay you against your investment. Now you invested 1 lakh rupee. Now you will expect a dividend on that. Now this dividend is paid out from the profits of the firm. So now suppose if a company is not making a profit, definitely there will be no money to pay the dividend. So you won't get any dividend out of it. There could be a possibility where the firm is exceptionally making good profits, but then also they are not paying out dividend. Now, why this happens? The reason being the company wants to retain back that money. Profit is earned by the firm, or profit is earned by the firm, but it doesn't want to distribute it to the shareholder. The reason being the company wants to reinvest that money, or it wants to invest that money in the business to grow its business. So that is the reason why dividend is not a assured return to the shareholder. Despite of a firm making a profit, the firm may hold back that profit so that it can reinvest for its growth. Okay, so these are the three major characteristics of an equity investment, which makes this investment to be little risky. Now your question would be why anybody would go and invest in these equity shares. The reason being, when we talk about returns to an equity shareholder, I told you returns comprises of two components. One is the dividend, which will be paid out of the company's profit. And the second one is, you call it as the capital appreciation. So the example what I gave you right now, this is unpredictable. The company may pay you dividend, may not pay you dividend. The second part, when we talk about capital appreciation, what is this all about? Now look at the previous example that we have taken. 10,000 shares you have, you purchased it for 10. So your investment was 1 lakh. Now the market value of the share is 20. So if I sell this 10,000 shares, I'll get a 2 lakh rupees. Correct? So the difference between my selling price and my purchase price becomes the capital appreciation for me. So this capital appreciation is basically based on the market price of the share, which we call it as the market value. Okay, so the market price is determined by the market. It is based on the demand and supply that happens in the demand and supply of the stock that is there in the market. Basically, that will give you the capital appreciation. So any investment in equity share is majorly driven by the capital appreciation motive rather than a dividend motive. Okay, so these are some of the characteristics to be very brief about equity shares. Okay, so this is the first source of capital that any company would prefer to. And since they are for a longer duration of investment, they are not to be repaid back when the company is in existence. Therefore, the risk is very, very high, and therefore they are called as the owners of the company. Okay, any questions? Any questions? Okay, let me move ahead. The second type of capital, equity, apart from equity, the second type of capital you call it as retained earnings. Now, what are these retained earnings? Retained earnings are nothing, as I said, whenever the firm makes a profit, out of the profit, the firm may retain back some money. Let us say, again, a hypothetical example, say the company had made a profit of rupees 100, for example. So the profit is 100 rupees. And the firm has paid, say, dividend payment. Say the dividend payment out of this profit is 60 rupees. That means remaining 40, this has been retained. So this is known as the retained earnings, or you call it as the reserves. So normally the firm will create these kind of reserve. It will hold back the profits so that it can invest. This money can be again invested. This 40 rupees can be again invested for growing the business rather than pulling in money from some other source. Okay, so it is their own money, what they have made out of the business or what they've earned out of the business. So then definitely that can be, again, they can use that money for reinvestment or for acquiring some assets. Okay, so that is known as retained earnings. So retained earnings are nothing but it is a share of profit that has been retained by the firm for reinvestment purposes or for meeting some contingencies. Okay, that is the concept of retained earnings. So a second source from where the firm pulls in money are the reserves, or you call it as the retained earnings. Now you might have heard about companies which have exceptionally, you call it as cash rich companies normally. Now why do we call them as cash rich companies? The reason being, these are the firms who have retained huge amount of profits. They've not paid profits for years together, and therefore they have created a huge amount of reserves. So if you look at Infosys, if you look at Microsoft, they have huge amount of reserves. So therefore we call these companies to be cash rich companies, because they have so much of money. They are not depending on the borrowings or some other source of funds to grow their business. Okay, so that is the concept of retained earnings. Any questions? Anybody? Any questions? Shall I move ahead? Then the third source you call it as the surplus. Now surplus is nothing but the current year's profit. Now there is a difference between retained earning. These are past profits. And surplus is nothing but the current profit. So whatever current profit you have at your disposal, you call it as your surplus for that particular year. So again, that money can be again utilized by the business for their investment purposes. So this is again one of the major source of funds that any company will have. Then the last and the important aspect is borrowings, or you call it as the debt. Okay, so debt is nothing but, now you know what is a borrowing, what is debt, what is a loan. So borrowings are nothing but they are for fixed. Now what could be the characteristics of borrowings or debt capital? It is the money is raised for a fixed tenure. The time period is fixed. So after that time period, either you have to repay back that debt or that debt will be converted into some other financial instruments. Okay, so debt has a fixed time period. Second, it has a fixed obligation. That means whenever you borrow, what is the return that you have to give? If you are taking a loan from the bank, what is the return that you pay to the bank? For the bank, interest becomes an income, but for you, it is a cost because you've taken the money from the bank. So interest has to be paid whenever you borrow or whenever there are any debt instruments in your capital. Whenever you're bringing in money from any debt instruments, the company has to pay interest, and interest is a fixed obligation. So when we say fixed obligation, it means irrespective whether a company has a profit or it has incurred a loss, despite of that, the company has to pay the interest interest once it has borrowed money from any source. Okay, so this is another major source of funds that a company depends on. I told you we are looking into corporate enterprises, so this is also one of the major source of funds that a company depends upon. So whenever you say there is debt, a company has borrowed funds, or when you say there is a debt in the capital of the company, the other terminology that we use is the leverage. So when you say leverage means there is some amount of debt or there is some amount of borrowing in the capital or with the company. So these are interchangeably used. Either you call it as debt capital or you call it as a leveraged capital. So they are one and the same. So these are some of the sources from where the money is pooled into the business. Now, it could be for starting the business, it could be for managing the business, or it could be for the growth of the business. Okay. So any question till here? Anybody, any question? Yes. There are no questions, we'll move ahead again. So let us go to now, I'm just going to talk about. Now we've looked into, there are two aspects I said. Business finance may you have the sources and you have the usage, or we call it as application. So it is application of funds. So there are two things. There are sources of funds and there is application. There are two aspects to it. Now when we said sources of funds, we talked about equity share capital. So you have a fair idea now. What is it? Second, we talked about reserves. We talked about surplus. What is the meaning of surplus? Reserves means past profits. Surplus means current year's profit. And then we looked into what is borrowings, or what we call it as the debt. So these are the three sources. Now when we have to, from where the money comes into the business. Now every source will have some cost to it. If you are raising the funds from equity, the company has to pay dividend. If you are using the reserves and surplus, then there is a opportunity cost, because that money could have been used for some other purpose rather than reinvesting. So there is an opportunity cost. If you borrow debt, or there is a debt component, then the company has to pay interest. So for every element of source of funds, there is some cost that is attached, or some cost has to be borne by the firm. So if it is a share, it has to be a dividend. If it is a reserve you are using, there is some amount of opportunity cost. If it is a debt, then there is an interest commitment that has to be met. Now you have brought in the money into the business. You have pulled in the money. Now what are you going to do with it? You're going to use it, use the funds now. Now how are you going to use it? There are two things. One would be you will invest. So it would be investment within business. This could be one. The second part is it is investment outside the business. So there are two aspects to it. So whatever money has come in, either you will invest within the business. Okay. Now when we say within the business, what am I going to do? I will use it for purchasing the fixed asset, or I will need the money for working capital. Okay. So anybody, what do you understand by fixed asset? You might have learned all these things. What is a fixed asset? So I'm going to invest in my business now. Correct? So what is a fixed asset? Anyone? Yes? Anybody? Okay, I'll move ahead if there is no response. So when we say fixed asset, that means these, now you brought in money into your business. Now you, what is your end objective? You want to make profit. So from where does the profit come? So it's a commercial enterprise. So I want profit. Profit is the end result of what? It is the end result of your sales. How does sales arise? Sales is the end outcome of production. Now, if you need to produce goods and services, you need machinery, you need equipments, you need factory, etc., etc. You need the manufacturing facilities. Now, what are all these? All these are nothing but they are the fixed assets. So, equipment, machinery, factory. Ultimately, why you are making an investment in all these? Because if I'm going to purchase these equipment, these machinery, then this is going to be used for production of goods and services, which I'm going to sell it in the market and I'm going to make a profit. So ultimately, the investment in fixed asset is driven with an intention of getting profit. So whatever money is invested into fixed asset, the ultimate objective of investment in fixed asset is to reap the benefits of profit. Clear till here? So fixed assets are the assets which are used for the production of goods and services. So in the long run, these are the assets that will help you to get the profit. Okay. So the objective of investment in fixed asset is to earn profit. Now, apart from fixed asset, there is a working capital. Now, what is this working capital? just reverse it. It is the capital that is required for the day-to-day working. So now once you have brought in the machinery, once you've purchased the equipment, once you have a manufacturing facility, now you're not going to keep it idle. That needs to be functional, correct? So for that, you need labor, you need raw material, you need electricity, you need stationery, you need printing, there are n number of things that are required. You need office staff, you need telephone, etc., etc. So many things are required. So I need, apart from investment in these assets, to make these assets functional, I have to incur other expenses. So those are known as working capital. So working capital is nothing but the capital or the money that is required for making these assets functional, or they are the support facilities through which you attain the sales or achieve the sales. Okay, so basically working capital is nothing, the capital that are required on a daily basis. So this capital is known as the working capital. Now, when we say this, the capital, the money that I require on daily basis. So when I say money that I require every day, that means I need cash on a daily basis. Now this availability of cash on daily basis is known as liquidity. So I need money to run the business. So that money or that cash on a daily basis, you call it as liquidity. So whenever you say the firm is in liquidity, uska matlab hai the firm has more amount of cash at its disposal. Okay. When we say the firm is more oriented towards generating profits, that means the company has more amount of investment in fixed asset. Okay. So there are two investments that are done within the business. One is the acquisition of the assets for the production of goods and services. And the second is the working capital, which is the availability of funds for running these fixed assets or for running and maintaining these fixed assets, so that you can use these fixed assets for the production of goods and services, and you can generate sales to derive the profits in future. Okay. So this is the investment that a firm will do within the business. So whatever money has come in from these sources, it is going to, you put some money into fixed assets, some money into working capital. Okay. Any question? Yes, anybody? Any question, any doubt? Yes, anything? Now the second part of investment, this is the A part where the money has been pulled into the business, within the business. Now the second one is where the investment will be outside of the business. Now when we say outside the business, that means the company can go and purchase the share of some other company. It can make a fixed deposit in a bank, or it can purchase some other financial instruments, say bonds or commercial papers, etc., for some other entities. So what happens? This is not within the business. This is outside. You are making the investment outside. So basically here your objective is not to make profit, not to maintain the liquidity, but here generally you make the investment outside the business to earn some income other than sales. So when we talk about, so basically this investment, whenever we talk about the investment outside the business, the focus is to earn some amount of income out of these investments. Okay. So, but for any company, the major source of revenue are the sales. Correct? For any commercial enterprise, the major source of income is the sales income. So when to the sales income, when you add this income, that is from the investment outside the business, what this is normally known as the other income. So in addition to sales, whatever income you're going to get. So to the sales, when you add this other income, what you get is the total income for the company. Okay. So when you look at the investment perspective is driven by three aspects. One is either to generate other income by making an investment in outside securities or some financial instruments, or it could be investment which is done in a fixed asset, or it could be an investment which is done in a working capital for managing the business. So when you look at any business decisions or say any decisions, now I have told you
Whenever you are raising the funds, for every source, there is a cost attached to it. For every investment that you do, there are some returns associated with it. So when you talk about the application of funds, this is with respect to the returns, what I'm going to get out of the investment. Correct? So what are we doing what are we doing basically here is we are comparing the cost with the returns. So ideally, any business decision where your returns are more than the cost, that is always a viable option. Okay, this has to be more as compared to the cost of the funds. Then only it is a viable investment option. Otherwise, if your costs are more and your returns are on a lower side, that means it is not beneficial or it's not a good business decision, because you have to pay so many things, you have to pay dividend, you have to pay interest, but you are not reaping any profits. So you're not generating any sales. Then in that case, what will happen? The business is not going to sustain for a long time. So when we talk about these two, the sources and the application of the funds, it is nothing but we are talking about the balance sheet of the company. So now basically what is a balance sheet of a company? The balance sheet of a company is nothing but it shows from where I have brought in money and how am I going to use that funds. That is what is a balance sheet all about. Okay, so when we say sources of funds, balance sheet will have an asset and a liability. So when I say sources of funds, I'm talking about my liabilities. Liabilities means all the obligations, because today I'm taking the money from these different, pulling the money from these different sources. But there is a commitment that I have to repay it back. Equity shareholder का पैसा भी वापस देना है आपको. If you are taking a loan, that has to be repaid back. So there is an obligation, and therefore you call it as a liability. And when you talk about the application, the usage of funds, these funds are going to give you returns. So इसीलिए हम इनको क्या बोलते हैं? We call it as assets. So assets are more focused with generating the returns, whereas liabilities are more related to the cost aspect. Okay, because for every liability, there is some cost that the company has to incur. So whenever we say, when we are calculating the return on investment, what is this return on investment? Return on investment is nothing but, you call it in short, we call it as ROI. What is this ROI? Your ROI is nothing but where your returns or your profits should be greater than your cost of your capital. Whatever you have, this is the cost of capital, correct? So whatever cost you have incurred, the return should be more. So your profit should be greater than the cost of capital, then only your ROI is on a higher side. But if this is the reverse, your profits are less and your cost of capital is high, that means your return on investment is on a lower side. So any company, whenever you look at the balance sheet of the company, immediately you will come to know what is the type of, what is the focus of the business. If the company is investing more amount into fixed asset and year on year you find that the company's fixed assets are increasing, that means they are acquiring more assets. इसका मतलब है the firm is into growth mode or there is some expansion that is happening, and therefore these acquisition of assets are happening. So ultimately that means in future there is a prospect that the profits of this firm will go on a higher side. But if a company is investing more on the working capital side, that means it is not profit oriented, but the focus is to maintain some cash balance at each point of time. Okay, so the focus is on liquidity and not on the profitability of the firm. Okay, so basically balance sheet is nothing but, therefore we say it shows the financial position. So financial position means as on a particular date, how much is the liability that I have to bear, or how much is the obligation that I need to pay for in future, and what are the assets that I have on that particular date, which is going to give me profit in the future. So balance sheet is more of futuristic perspective. We say 31st of March, as on 31st of March. What does that mean? On that date, this much is the liability that I have, and these are the assets that is going to give me some income in future. So it talks about the future. Okay, clear? Any questions? Yes. Any questions you all have? Anybody? Any questions? Okay. So that was about the concept of sources and application of funds. Now, whenever you talk about the financial statements, what is the balance sheet? I told you just now. Balance sheet is nothing but it tells you, it gives you the state of a particular company on a particular date. Okay, therefore we call it as the financial position of a firm. Okay, so balance sheet comprises of assets. Assets are nothing but the investment which the company is doing for its growth, and the objective is to derive the profit. And second, the investment can be in working capital. The objective is to earn, is to have liquidity, or it could be the investment that the company is doing outside the business. Okay, so these are, this is an, so assets, when we say, they are known as capital expenditure. Now, what is a capital expenditure? Capital expenditure is, today you are buying an equipment or a machinery. The intention of buying or acquiring that asset is to use that asset for manufacturing goods and services, or for producing goods and services, which is going to give you revenue in future. So you make an investment today, but you are going to get the benefits in future. Therefore, fixed asset investments, you call it as capital expenditure. So capital expenditure are the ones wherein today you make the investment, but the benefits you will get in future. So as I said, balance sheet is all about the future. So therefore, whatever assets you will have in the balance sheet, it talks about in future, these assets are going to give you either liquidity or they're going to give you the profits in future. Okay. Liability will indicate what you have to pay for in future. Okay. Now this is, balance sheet is one of the important financial statement. The other one is, normally we call it as a profit and loss account, or this profit and loss statement. Now what is a profit and loss statement? Profit, normally how do we calculate? Profit and loss statement is nothing but, it is no, normally it indicates what is the end result of any operations. As I said, any commercial enterprise, the ultimate objective is to earn profit, correct? So how are you going to assess whether the firm has made a profit or a loss? So for that, you need to prepare a statement. And therefore, every company will prepare a profit and loss account, or you call it as a profit and loss statement. Now this profit and loss statement will indicate how do you calculate profit? Simple. It's based on the fundamental rule. The profit is nothing but it is income minus all your expenses. So when we say income, income means what I have received. Okay. Now income is what I have received. And when you say expenses, what I have paid for during this year. So that means you have already received, you have already paid for. So therefore, profit and loss account is a history. It is based on, it's a past data that is there. So whatever has happened during that one financial year, that is reported in the profit and loss statement. So then you cannot change this. Whereas when you talk about balance sheet, it is more on the futuristic side. But when you look at the profit and loss statement, it is the past. Already I have received the income. Already I have paid for the expenses. I have nothing to receive. It's not receivable and payable. So when it is received and paid, it comes in the income statement. When it is receivable, that means in future I am going to receive, or when you say it is payable, in future I have to pay, that means it becomes a balance sheet item. So this is a basic difference between a P&L and a balance sheet. So profit and loss, it is either received or paid. Balance sheet is either it is receivable or payable. Okay. So that's the basic difference between these four concepts. So when we say for any company will look at what is the income. Now, when I say income, income comprises of two components. Major source of income for any company is the sales or the turnover, what we call it. So the sales is the top line, the major source of income, plus the other income could be another source. That is how you arrive at the total income. So total income comprises of the income that is generated out from the sales by using the fixed asset. And second is the other income which is derived from the investment which you've done in the financial instruments or other outside the business. So that constitutes your total income. From that, you will set off all the expenses. So whatever expenses you have incurred for generating these incomes. So all that expenses will be reported here. So anything surplus is left off, then you call it as a profit. If there is a deficit, then you call it as a loss. So profit and loss account gives a picture of what has happened in the past, what has been received and what has been paid for in the past. And it normally indicates the end result of any activity, any commercial activity. So whether the company has made a profit or whether it has made a loss, that will be through a profit and loss statement you'll be able to identify. That is the use of P&L statement. Then the third financial statement that is we use is the cash flow statement. So cash flow is nothing but from where the cash has come in and for what purpose the cash has been utilized. So that's the cash flow statement. So these three, balance sheet, as I told you, what you want to receive in future, what you want to make the payment in future. So that is a balance sheet. Profit and loss statement is what you have already received and what you have paid for. Cash flow is how much is the cash that is available and how much is the payment that has to be, how much is the cash that needs to be paid in that particular, has been paid in that year, comes under the cash flow statement. So this is just an overview of the fundamental concepts that are there in business finance. Normally what we take it in depth, in detail, we carry forward. So, but I've just given you some overview as to the sources and the application, the general overview of the P&L statement and the cash flow statement.